Welcome. Today we have a different video that we haven't done in the past, which is where I'll be reviewing different stocks that I have in my watch list, but I still haven't actually purchased or included in my portfolio yet. Now, before we jump into the video, we can actually take a look at our portfolio right here. We have currently 9 holdings, and my objective for this year is actually to exit some of those holdings which I don't have the highest conviction on. For example, Period Holdings, which has been an underperformer for me, or even Crocs, because I expect my investment thesis to play out at the end of 2025 or starting 2026. Overall, I'm very happy with the performance of my portfolio, and so I would want it to be a lot more concentrated. We can see some of the combined statistics for the portfolio on the left hand side, where you can see that although I'm not focusing on it, we have a dividend yield of 0.34%, which I will take. It's not bad when you're not focusing on dividend investing. Our companies have a revenue 3-year CAGR of 25%, which is beating the market, and they have a return on invested capital of 22%, which is extremely solid, and it means that our companies know exactly how to invest their capital. Now, the tool that we'll be using on this video is FinChat, and just to say, this video is not sponsored at all, but I just fell in love with the platform. You can track your portfolio investment, you can research stocks, and you even have sort of a chat GPT, but for researching stocks, where you can ask anything related to companies, and it will even search inside their annual reports for the answers. If you're interested in this, you have a link down below where you can save up to 15% if you join. However, having said that, let's jump straight into the first stock. Now, the first one on the list is Microsoft, and this may not be a surprise to anyone. This is a company that completely destroyed 2023, as we can see in the price chart. However, in 2024, or if we look at it 1-year return, it hasn't actually delivered a lot, and it has been very stagnant. However, when we look at their ratios, this company is almost unbeatable. They have a return on capital employed of close to 31%, which is great, net margin of 36%, and the revenue for the past 3 years has been growing at close to 13%. And this is a company that has a $3 trillion market cap with $250 billion in revenue. This company is not cheap. This is why in 2024 it barely moved at all. It's currently trading at a 35 price to earnings, and this is one of the main reasons why I have not managed to pull the trigger on this company yet. Now, if we look at the top line and the bottom line growth over the past 9 years, we can see that they have delivered big time. From June of 2015, where they had around $100 billion in revenue, all the way up to June 2024, where they had $250 billion. And look at that surge in net income, from $12 billion all the way up to $88 billion. However, if we zoom in a little bit more and we change the view to quarters, we can see that this growth has not been as sharp. We can see that their bottom line has stayed pretty consistent with a fair increase, which is the same as its revenues. However, that this company at this size is still growing at this rate is unbelievable. But I'm not extremely sure if their growth rate actually deserves such a high price to earnings ratio. However, Microsoft is a great company and will always be a great company, and if this dips down to a solid price, I'll be looking to buy it. Stock number 2 is none other than Netflix, but this company has also been on a tear for the past years. We can see just how quickly the company's share price has increased since July 2022 all the way up to now, more than quadrupling in value in 2 to 3 years. And this company also has extremely good ratios, with a return on capital employed of 18%, a net margin of 21% and expanding rapidly, and a revenue CAGR for the past 5 years of 15%. Now, the crazy thing about this company is that when we look at it for a trailing 12-month valuation, their price to earnings is close to 50 times. But when we look at its forward price to earnings ratio, it's closer to a 39 times, which, don't get me wrong, it's still overvalued, but it makes it a little bit more reasonable. When we look at this company's financials year over year, we can see that it has not had a beat down year, growing every single year at a pretty rapid pace, and as we can see, especially in the last 12 months. Additionally, they have been expanding their net profit margin extremely rapidly. And when we transform this into the quarterly view, we get more of the same. Every single quarter they have been growing their revenue extremely consistent, it looks extremely predictable, and their margins are not going down. At the year end in December's, their margins go down a lot because I'm guessing that they include all their one-off expenses or one-off income. However, for the rest of the year, we can see that their margins are rock solid and even increasing consistently, currently sitting at a 24%. So I would love to own Netflix, but I think that currently it has just run too far, and holding a free cash flow yield below 3%, I would prefer to wait on this stock to dip down and then scoop up some shares. But don't worry, because there are a lot of good stocks out there. Next, we have Copart, which is a provider of online vehicle auctions and vehicle remarketing services for those cars that are beyond repair. I am aware that this company is not as famous as the other two, however, this company is still a big deal, sitting at a market cap of around $55 billion, with a return on capital employed of 27% and a net margin of 32%, and this is while conducting a business that is not by any means what you would consider sexy. They have taken a space that has been overlooked by a lot of different competitors and have just monetized it incredibly well. Currently holding a price to earnings ratio of around 40 times though, which is why at the moment I'm staying away from this stock. However, the quality of this business does imply that it will be always trading at a hefty valuation. When we look at the yearly financial evolution for this business, it does seem like revenue has been slowing down in the past year, or at least in the last 12 months. However, we can see that the net margin that they have achieved of over 30%, they have been able to maintain for the past 5 years. And this is even more surprising because it peaked in COVID, meaning that during the recessions and adverse economic conditions, it looks like it is performing well as well. Now, there is one thing that is extremely good about this business, and it's also their free cash flow generation. They're a free cash flow generating monster, but they decide to reinvest the majority of it into opening new locations, expanding internationally, and just boosting overall that top line, which can then improve their net profit and even their free cash flow generation even further. And again, when we break this down into quarterly financials, we can see that it is extremely predictable. Every single year looks the same, with January or their latest quarter of every single year using up all their different free cash flow to use in the different investments, and the other 3 quarters maintaining a solid margin, increasing their revenues, but overall being extremely predictable. This company is very solid, and I would love to buy it as it is the typical Peter Lynch boring stock. However, its hefty valuation and my lack of understanding for the sector, which is very cyclical, have made it a hard buy for me. But don't worry, because now we have coming up another unsexy stock. And this is none other than Rollins. And this is a pest and wildlife control services company which offers these services through its different subsidiaries. I know this looks like one of those weird companies which never go anywhere, but you can see the way their price has evolved in the past 5 years. It's more than doubled, and we can see that its return on capital employed is over 30%, its net margin is a bit more tight with a 14%, and its revenue growth is a bit slower, with its 3-year CAGR being around 12%. Additionally, it is also trading at a hefty valuation of 47 times, but what can I tell you? Nowadays it's very hard to find high quality companies that are not trading at very hefty valuation. I know all these companies' financials look the same, but trust me, it's hard to find companies that have these extremely solid financials which look predictable, have increasing margins, improving top line, and just overall positive signs. Of course, then you have to do a bit deeper research to understand the industry dynamics, all the different aspects of the company, but look at that net margin increase paired with a fairly quick revenue increase. And the best part is this, that when we break it down to quarterly and we add in the free cash flow, it looks even better, because they're extremely efficient at turning all their profits into free cash flow, and those margins are extremely stable. Here it looks like they go up and down all the time, but the lowest value that is shown is at 12% and the highest is at 15%, and this has been the trend over the past 3 years, with the revenue being extremely stable but consistently increasing quarter after quarter. What else can you ask for? Well, yeah, just a lower valuation. Now I will present 2 last stocks, with the last one of course being my favorite and one that I'm actually very inclined to purchasing at the current moment, but I have not had the time to do the due diligence lately. Now firstly we have Duolingo, which will come as a surprise to many, but when you look at the price chart I think you will change your mind. Now this company has been growing at a 45% revenue 3-year CAGR, and I discovered this company by accident, we can say. I never thought a company like Duolingo could be considered a growth stock, and I even find it weird that this company is becoming profitable and improving their margins. Of course, we don't have a return on capital employed because in the past they haven't had positive earnings, but their net margin is currently sitting at around 13%. Now, if we were complaining about valuation previously, this company is currently trading at a 175 price to earnings. This graph over here is perfect to show you that this year, 2024, has been a perfect turnaround year for Duolingo. They had been burning cash for a very long time since 2019, and in 2023 they managed their first profitable year, which is a very successful achievement. But we can see the turnaround that this company has had in only 1 year, going from a 3% margin all the way up to a 13% margin. And that orange bar over there, yes, that's their free cash flow, and it's more than double their net income. When I told you that 2024 was a turnaround year for this company, I wasn't lying. In the first quarter of 2024, they achieved a net margin of 16%, which since then has been decreasing all the way up to 12%. But this was an increase of 2 times in comparison to the prior quarter in December 2023. Now this shows you that this company has pricing power and they're able to leverage it in a correct manner. Of course, at the current moment, this app is more focused on growing their top line than improving their net margin, but they're still able to make very good strides in that direction. And this is why I would be very inclined in taking the risk of owning Duolingo if I was able to get this company at a more reasonable valuation. However, at this pace, it doesn't seem like it will ever come back down. And now last but not least, we have Stride, ticker symbol LRN. And this company has of course also destroyed the market, timesing its value by 5 over the past 5 years. However, when we look at their financials, it looks like this is not such a fast-paced grower, with a 3-year revenue CAGR of 10%, a return on capital employed of 12%, which is just around our threshold of 15%, and a net margin of 11% as well. So why has this company performed so well when their KPIs and the different ratios aren't that solid? Now, before we move on, look at that price to earnings ratio. It's close to 20 times. This is why this is my favorite company in the list, and I want to actually find the time to research it in order to own it. Now, these are the yearly financials for Stride. It started to pick up growth just after COVID because as they help schools transform their offerings and add in different online options to their already taught academic programs, it started picking up pace when schools actually started to need it. We can see that their net margin has been increasing every single year since 2020, and their revenues have been growing quite nicely alongside. Also, this company has it figured out. Again, look at their free cash flow generation, also above their net income. And over here, we can see their financials when we break it down into quarters. It looks extremely predictable, doesn't it? Well, this is because their main source of revenue is recurring revenue, which comes out of all their clients. And now, it does look like a red flag that their latest quarterly earnings had a smaller net margin of 7%, doesn't it? But take a look at if you compare it with the previous years. In September 2023, it had a 1%, and in September 2022, it had a negative net margin. So it looks like this is the quarter where they decide to actually invest a lot of their money and accrue all of their different one-off expenses and other items that would lower their margins. Now, I would love to own this company, but I still have a lot more due diligence to conduct on it before I start a small position. But anyways, this is the end of the video. I hope you enjoyed. If so, let me know in the comments so I can do another one. And as always, thank you for watching. This has been the Cashflow Compounder, and I'll see you on the next one.